In Dubai right now, at this exact second, you cannot buy a 1-ounce silver coin for less than $99.93. Not 99 cents, $99. The Comex futures price says $79, but in the physical market, in the real world where metal actually changes hands, the price is $100. That is a $27 premium. A 34% markup just to touch the metal. This is not a spread, this is a fracture. The paper market and the physical market have divorced. And when I show you what happened in the last 72 hours, you will understand why $100 silver is not 48 hours away. It is already here. You just don't see it yet on your screen. Chinese retail buyers just bought more silver in 3 days than most countries mine in a month. Trump threatened military operations against Colombia and sparked a commodities panic. And $5 billion of silver futures are about to be forcibly sold by index funds in the next 2 weeks. 3 forces, 1 outcome. The biggest supply crisis in modern commodity history. And I have the data to prove it. Let's go. January 6th, 2026, silver closes at $78.54, up 161% in 12 months. That is the official number. But here's what they are not telling you. Bloomberg just reported that the Comex March 2026 contract, the most actively traded silver futures contract in the world, closed Friday at $72.26 per ounce. Yet the cheapest 1-ounce coin you can physically buy in Dubai, one of the largest bullion hubs on planet Earth, trades at $99.93. Let me repeat that. Futures say 72. Physical says 100. That is not a fabrication premium. That is a market screaming there is no metal left. And Dubai is not an outlier. In India, retail silver hit 248,100 rupees per kilogram. That is $91 per ounce equivalent. In the United States, APMEX is charging $95 for a random year American Silver Eagle. The spot price is $79, $16 premium, 20% over spot just to get delivery. This is backwardation at a scale we have never seen. Physical metal trades at a massive premium to paper contracts. That only happens when supply is gone. And the supply is gone because of what just happened in China. Bloomberg published a report 6 hours ago titled Chinese Silver Buyers Fuel Latest Rally in Busy Markets. The headline undersells the story. What actually happened is this. Chinese retail buyers, not industrial users, not hedge funds, regular people walking into jewelry shops, and bullion dealers just purchased a staggering amount of physical silver in 72 hours. The report confirms that retail purchasers played a crucial role in driving the latest price surge. Why? Because China's buzzing bazaars are a good place to check the temperature of precious metals. And right now, the bazaars are on fire. Chinese citizens are panic buying silver. Not gold, silver. And they are paying premiums that would make your head spin. Why the panic? Because they see what is coming. China controls 60 to 70% of global refined silver production. And this year, they locked the vault. Export licensing restrictions went live. Only large state-approved enterprises with annual production capacity exceeding 80 metric tons and credit facilities over $30 million can export. That wipes out hundreds of small and mid-sized refiners who used to supply the world. The metal is trapped inside China. And Chinese citizens know that once the export window closes, domestic prices will explode as industrial users fight over finite stockpiles. So they are buying now, jewelry, coins, bars, anything. The bazaars are emptying, and that buying wave just sent a shockwave through global markets. But the Chinese buying frenzy is only the first force. The second force hit 72 hours ago when Trump threatened a military operation in Colombia. On Sunday, January 5th, Trump was asked by reporters if the U.S. would conduct an operation in Colombia. His response, sounds good to me. This is not a throwaway comment. This is doctrine. Trump has already captured Venezuelan President Nicolas Maduro in a military raid. He has threatened Cuba, saying it is ready to fall. He has warned Mexico to get their act together. He has demanded Greenland for national security. And now Colombia is in the crosshairs. Why does this matter for silver? Because geopolitical instability drives safe haven demand. When Trump threatened Colombia with 50% tariffs in a deportation standoff, coffee prices spiked. Oil reacted. And precious metals caught a bid. Gold surged 66% in 2025. Silver surged 148%. And 2026 is accelerating. Every time Trump threatens military action, every time he imposes tariffs, every time he destabilizes a resource-rich region, commodities reprice. And silver sits at the intersection of 2 megatrends: industrial necessity and monetary safety. You cannot build solar panels without it. You cannot manufacture semiconductors without it. You cannot power the EV transition without it. 50 to 60% of silver demand is industrial, and that demand is non-negotiable. A semiconductor fab does not shut down because silver hit $100. They pay the price or they lose contracts. Priceless inelastic demand meeting supply destruction is the formula for vertical moves. And now the third force, the forced liquidation event that nobody is talking about. Bloomberg reported that silver futures make up 9% of the Bloomberg Commodities Index. That is a widely tracked benchmark used by institutional investors. But in 2026, the target weighting for silver drops to just under 4%. That means index funds have to sell over $5 billion of silver futures in the next 2 weeks. $5 billion. Daniel Gawley, senior commodity strategist at TD Securities, wrote in a note, "We expect a massive 13% of aggregate open interest in Comex silver markets will be sold over the coming 2 weeks to result in a dramatic repricing lower." He is predicting a crash. Lower post-holiday liquidity may amplify price moves. But here's the problem with that analysis. It assumes there is physical metal to absorb the selling. There is not. Look at the inventory. Comex registered silver, the metal available for physical delivery, sits at 39.4 million ounces. In the first week of January, 17.2 million ounces were delivered. That is the largest delivery surge since 1980. At that burn rate, Comex has 4 to 5 days of supply left. Shanghai Futures Exchange lost 46 metric tons, 1.5 million ounces, in a single session on January 2nd. First day back from holiday, Chinese domestic buyers consumed 1.5 million ounces instantly. At that rate, Shanghai goes to zero in 14 days. So when TD Securities says index funds will sell $5 billion of futures and crash the price, they are missing the point. The futures price is irrelevant. The physical market sets the real price, and the physical market is sold out. Let me show you what sold out looks like. SD Bullion, one of the largest U.S. dealers. American Silver Eagle Page, out of stock. Next shipment, March. We are in early January. 8 weeks with zero inventory. Kitco, not even taking orders. Their Eagle Page says unavailable, no backorder option. When a dealer refuses to take your money for future delivery, it means they are terrified of defaulting. AppMex, $95 for a single random year coin. Spot is $79, $16 premium. Want a current year mint condition coin? $98 to $100. Generic Buffalo rounds used to trade at $2 over spot. Now $8 over spot. Junk silver, pre-1964 US coins, 40% premiums over melt value. There's no cheap silver left anywhere. And this is not just a US problem. This is global. Dubai, $100 coins. India, $91 equivalent. Retail premiums are exploding because replacement cost is exploding. Dealers know what just happened at Comex. They saw 17 million ounces delivered in 2 days. They know JP Morgan and Citigroup grabbed 4.4 million ounces, and Deutsche Bank bled 3.2 million. They know the big banks are hoarding metal. So when dealers call their wholesale suppliers today to restock, the phone will not be answered. Or if it is answered, the price will be $10 higher. Dealers are raising prices tonight to protect themselves from tomorrow's scarcity. This is the trickle-down effect of a bank raid. First, the banks raid the exchange, then the mints run out of bars, then the dealers run out of coins, then the premium shoots to the moon. We are in the final stage. Now, let me address the elephant in the room. Can the Comex survive? Mathematically, no, not at current demand rates, but let me be precise. The Comex will not default in the traditional sense. They will not shut down. What will happen is cash settlement. When the metal runs out, they will offer contract holders the dollar value instead of physical delivery. The moment that happens, confidence in paper silver evaporates. Every holder of a futures contract will demand delivery immediately. It becomes a bank run. And the price required to clear the market, to bring metal out of hiding, to incentivize recycling, to destroy marginal demand, could be double or triple current levels. $100 is not the top. It is the floor. If we breach 100 in the next 48 hours, which is increasingly plausible given Chinese buying and geopolitical acceleration, the next resistance is 125. Then 150. The Hunt brothers took silver to $50 in 1980 when industrial demand was a fraction of today's levels, when China was not export restricted, when Comex inventories were vastly larger. Today's setup is exponentially tighter. The 1980 comparison undersells the current crisis. Let me give you the trade setup for the next 48 hours. Watch 3 indicators. 1, Wednesday's Comex delivery report. If delivery notices exceed 5 million ounces, we are on track for another record week. That accelerates the inventory drain and pushes us toward the critical 30 million ounce threshold. Below 30 million, the mathematical probability of forced cash settlement spikes. 2, Shanghai physical premiums. If Shanghai spot prices push above $85 while Comex sits at $79, arbitrage pressure intensifies. Traders will buy Comex futures, demand delivery, ship metal to China for the premium. That drains Comex even faster. 3, Trump's next move. Any military threat, tariff announcement, or commodity export disruption adds rocket fuel to safe haven demand. If Trump follows through on Colombia, if he moves on Cuba, if he escalates with Mexico or Iran, precious metals will spike within hours. Markets do not wait for confirmation, they front-run the chaos. And chaos is Trump's operating system. Every threat is a volatility event. Every volatility event reprices risk. And silver is the leverage play on global risk. Here is the probability matrix. Base case, 40% probability. Silver consolidates between 78 and 83. Delivery report shows moderate demand. Chinese buying slows after the holiday surge. Index fund selling creates a paper dip. Physical premiums stay elevated but do not widen further. We drift toward 100 over the next 2 weeks. Bull case, 40% probability. Delivery report shows another massive surge. 8 to 10 million ounces demanded. Comex inventory drops below 35 million. Chinese premiums hit 85 plus. Trump makes a major geopolitical move. Colombia, Cuba, Iran. Index fund selling gets overwhelmed by physical buying. Silver breaks 90 by Wednesday. Hits 100 by Friday. Physical market goes into full panic mode. Dealers stop taking orders entirely. Premiums hit 30 to 40%. This becomes a runaway freight train. Bear case, 20% probability. CME announces emergency margin hikes to $50,000 per contract. Large speculative longs liquidate, paper price drops to 70. But, and this is absolutely critical, physical premiums stay elevated. Dealers do not drop prices. The bifurcation widens. This creates a buying opportunity in futures for those who can take delivery. But it does not help retail buyers. Retail loses in every scenario where they wait. Now let me give you the counter-narrative so you understand both sides. Bears will argue silver always crashes. It is too volatile. It is manipulated. Wait for the dip. Here is why that thinking is lethal right now. Yes, silver crashed in 2011 from 49 to 26. But Comex had over 100 million ounces of registered inventory. Today, 39 million. Yes, silver dropped to $12 in 2020 during COVID. But there was no China export ban, no inventory crisis, no backwardation. Those crashes happened when supply was available, when dealers could restock, when the paper price and physical price were aligned. None of those conditions exist today. The dip strategy assumes sellers will appear at lower prices. But if the metal is not available, if dealers are sold out, if premiums are 20 to 30% over spot, there is no dip in physical. The paper price might dip on margin hikes or coordinated futures dumping. But your ability to buy physical at that dipped price is zero. APMX will not drop to 65. It will stay at 95 or go to 105. The dip buyers are chasing a mirage. They are watching a fake paper price while the real physical market runs away from them. Here is my final conclusion. The $100 breakout is not 48 hours away because of chart patterns or momentum indicators. It is 48 hours away because the physical market is out of metal and the repricing mechanism is live. We have never seen this combination. China export lockdown, Comex inventory at multi-decade lows, backwardation at record spreads, industrial demand acceleration, geopolitical instability under Trump, forced index fund liquidation, Chinese retail panic buying. These are not forecasts. These are current conditions, measurable, observable, undeniable. The data is screaming. Dubai, $100 coins. India, $91 silver. APMX, $95 Eagles. Comex, $79 futures. The spread is $27 in some markets, 34%. That is not normal. That is terminal. The system is breaking. The paper price is losing control of the physical price. And when that control is fully lost, the repricing is not linear. It is exponential. Because once the market realizes the metal is not there, every holder of paper demands delivery simultaneously. That is the bank run. And we are standing at the edge of it. Wednesday's delivery report will tell us if we step over, if we see another surge, if Chinese buying continues, if Trump escalates. We will be at 100 by Friday. Not because I predicted it, because the math demanded it. If you want a position for this, here's the framework. Do not chase paper. Paper is the thing that is breaking. If you want exposure, you need physical or mining equities with operating production. Physical means coins or bars in your possession, not ETFs, not allocated accounts, not pool accounts. Your metal, your vault, your safe. Because if this goes to a delivery crisis, counterparty risk explodes. People holding paper IOUs will be left with paper. People holding metal will be holding the only asset that matters. Mining equities are leveraged plays on the metal. A 10% move in silver generates 30 to 50% moves in profitable miners. But you need producers with all-in sustaining costs below $50 per ounce. At $80 silver, they print money. At $100 silver, they mint fortunes. But equities have market risk. If the broader stock market crashes, Miners sell off despite rising silver. So physical first, equity second, paper never. The window is closing, not in months, in days. Wednesday's report, Chinese premiums, Trump's next threat. These are the triggers. And any one of them could light the fuse. Subscribe for the updates as this unfolds. Comment if you are holding physical or scrambling to find any. Share this with anyone still watching the futures chart, wondering why their dealer is sold out. This is the biggest supply crisis in modern commodity market history, and you are watching it live. The question is not if silver hits 100. The question is whether you're positioned when it does. That is the analysis. I will see you on the other side of $100.